Over the last several months, I went back and studied 19 precious metals bull markets, spanning gold, silver, platinum, and palladium. Different decades, different monetary systems, different macro environments. The goal was simple: to understand what a real precious metals bull market actually looks like, how long it lasts, how far prices tend to move, how those moves are measured objectively on a chart. Can we extrapolate the findings to the current bull market and make better returns than average? As soon as I started looking at the data, something hugely important became really clear. Understanding this will put you ahead of 95% of home investors on this topic. This is the Smart Wealth Code, your compounding machine. Let's dive in. So let's first understand what is a bull market. A bull market is defined by a sustained upward trend with higher highs and higher lows, typically signaled by an index or stock or metal gaining 20% or more from a recent low, accompanied by strong volume on price increases and lower volume during pullbacks, reflecting widespread investor optimism and economic growth. Every bull market in the study was identified using the same framework. First, I located a major cyclical low, a point where price had based for an extended period and downside momentum was exhausted. Second, I tracked a sustained multi-year advance, not a short-term rally or a reactionary bounce. Third, I identified a clear peak, usually marked by extreme sentiment, volatility expansion, or a macro inflection point. The percentage gain is measured from the absolute low to the ultimate high of that cycle. The duration is measured from the low to the high in years. No cherry picking, no intraday spikes, only structural bull markets visible on long-term charts. Now, have a look at this chart. I will reveal the name in just a bit. What do you think of the bull markets defined in this chart? We can easily make out that the bull markets tend to emerge after long periods of neglect. And when bull markets do emerge, they are not short-lived. They can easily go on for years at a time. We also see that the bull markets give massive returns once they start. We see a 538% jump in price from 1977 to 1980, 773% jump from 1997 to 2001, 294% jump from 2005 to 2008, 410% jump from 2009 to 2011, and 635% jump from 2016 to 2022. The name of the metal is Palladium. The metal has given an average of 530% returns per bull market once it starts, and the average duration for the same is 4 years approximately. Moving to silver on the charts, silver spends long periods going nowhere, years of consolidation, years of underperformance, but when silver breaks out, it doesn't trend, it accelerates. Historically, silver has delivered over 1,100% gains on 2 separate occasions, measured from deep cyclical lows to final speculative peaks. That dual role, monetary and industrial, is why silver bull markets are short, sharp, and emotionally intense. Silver has given an average return of 594% per bull market and taken 3.8 years on average to achieve the same. We will use this data in a short bit. Gold bull markets unfold differently. They begin quietly, often before inflation is obvious and well before the public pays attention. Historically, gold has delivered 398% return in 1971 to 1975 bull market, 649% return in 1977 to 1979 bull market, 640% returns in the period from 2001 to 2011, and 97% return from 2016 to 2020. Gold builds structure, absorbs capital, and sets the foundation for the rest of the complex. On average, gold gives a 446% return per bull market in 4.5 years. The last metal used in the study is platinum. Platinum bull markets are rarer, but they tend to emerge after long periods of neglect. Platinum can underperform for years until supply tightens or demand shifts. When that happens, price doesn't creep higher, it reprices. Notably, 2 bull markets stand out. The 1977 to 1980 bull market gave a return of 600%, and 1999 to 2008 bull market gave 558% returns. Averaging all the bull markets, platinum gives 321% returns in 4 years per bull market. This is the table summarizing all the 19 bull markets studied. The average return across all the bull markets was 472%, and the average duration being approximately 4 years. These figures don't predict the future. They simply describe what has happened historically on average. Now that we have the historical framework, we can apply these averages to current bull markets to create reference points, not predictions. Silver's current bull market began in November 2022 with a price near $17.80 per ounce. Applying the 472% average return in the 4-year average duration, silver projects to reach approximately $102 per ounce by November 2026. That represents a 48% gain from current levels in less than 1 year, if the historical average continues to unfold. Gold's bull market also began in November 2022. With a current price near $4,400, applying the same historical averages projects gold reaching approximately $9,255 per ounce by November 2026. That implies a 110% gain in less than 1 year from today, based purely on historical context. Palladium's bull market began more recently, in January 2025. With a current price around $1,771, the average framework project Palladium reaching approximately $5,204 by January 2029. That's a 194% gain over roughly 3 years. Platinum currently trades near $2,062. Using the same historical averages, platinum projects to reach approximately $5,232 by February 2029. That represents a 154% return over about 3 years. It's essential to understand that these targets are averages and not investment advice. Some bull markets undershoot, others overshoot dramatically. For example, silver has delivered 1,100% gains before. Applying that magnitude to the current cycle would imply silver prices near $222 per ounce, far above the average base estimate. Similarly, gold has delivered 650% gains in the past. Applying that scale to the current cycle would imply gold prices near $12,000 per ounce. These examples aren't predictions. They're illustrations of historical possibility. This is not investment advice. This is not a forecast. It's a framework for understanding potential. By studying what precious metals have done across multiple cycles, you gain perspective on the scale of moves these markets are capable of. The goal isn't certainty, it's informed decision making. If this deeper breakdown helped add context, like the video, subscribe, and share it with someone who believes precious metals don't move. History suggests otherwise.